Sometime last month, Deepak Shenoy of Capital Mind dropped this inquisitive tweet. It was about this platform called the 12% Club, and as it happens so frequently on Twitter, there were a lot of reactions. In fact, Suhail Samir from Bharat Pay joined the conversation. But you know what? I was interested in that 12% part. I mean, Deepak also has this chapter titled Suckered in his book, but 12%? I don't mind getting suckered. And therefore, I prepared a list of 5 different alternative investment products that offer pre-tax returns ranging from 11% to 20%. Interestingly, none of these products are linked to the stock market and are being positioned more as a viable alternative to fixed income products like a corporate bond or a bank fixed deposit. Now, because I haven't invested in any of these 5 products, I gathered information about them from a neutral outsider's perspective. And while I was researching this video, the only question I was trying to answer in my head was, will I have this product in my own fixed income portfolio? So that's what I'm going to answer today. But before I begin, and if you are new here, then I request you to subscribe to my channel, and for everyone else to tap on the like button, as it will definitely help me with the YouTube algorithm. And with this, let's move to product number 1. Alright, so from what I have discovered, the 12% Club is not a P2P, a peer-to-peer lender. Instead, it is a tech platform that deploys our money with its NBFC P2P partners and also facilitates borrowing from them. So essentially, the 12% Club is merely a sourcing partner, and therefore it does not guarantee any returns on one's investment. To put it as a construct, investors lend on a P2P platform with an interest expectation of 7 to 15% per annum. And likewise, there are also people who borrow at a 10 to 30% annual IRR. Now, a platform like 12% Club, Credmint or MobiKwik Extra sits somewhere in the middle and matches borrowers and lenders within their desired risk-return profile. Of course, they do so with a lot of charm, with features like a 9 to 12% annual interest, no lock-ins, daily credits, and initial deposit amounts which can go as low as 1,000 rupees. Now, as per RBI's website, there are 25 registered P2P lenders, and like any lending institution, they will have their own technology, target market, credit evaluation tools, underwriting, collection assistance, etc. In a peer-to-peer scenario, these entities act more as facilitators and offer lenders a range of borrowers as per their preferred loan criteria, location, employment history, reason for availing the loan tenure, which is typically between 3 to 36 months, and the desired rate of interest, which ranges from 12% to 35%. From a returns perspective, and I have picked this point from the Equiloans website itself, where they say lenders can expect a net pre-tax yield ranging from 7.5% to 10% on their net invested amount. So that's from the horse's mouth, and if you're considering investing in a P2P platform, the 7.5 to 10% should be your return expectation. The other big question is that of risk, and the biggest risk in any lending business is borrower default. Now, I looked at a lot of data, and the default rate on these platforms is generally being quoted at 3 to 6%, which I thought was a bit low. I mean, this graph here shows the gross NPA trend of Equiloans for the last few years, which certainly paints a pretty picture. And therefore, I picked up the phone and spoke to a relative who had himself lent money on a P2P lending platform and received mixed results out of it. So while he had good success and made a little over 12% when he lent the money for the first time, his second innings was less than satisfactory, with 2 of the 15 borrowers defaulting, which brought down his returns to just about 3%. He also gave me some useful tips. So if you want to experiment, then start with small sums of money. Don't get blinded by high interest rates, because the potential default is also on the higher side then. Always ensure you assess the borrower's profile before giving the loan, and always lend to multiple borrowers rather than to just one, so that the risks can get spread out. On my part, and after doing this research, I am a bit non-committal on P2P lending, and I'll certainly need a lot more information before I can make up my mind. Alright, so fractional real estate is a concept where investors come together to own a commercial property collectively, which means every investor is a fractional owner, and platforms like Strata and PropShare facilitate this process. They do this by creating a special purpose vehicle, then they pool in the investor's money, they buy the property in the SPV's name, and make each individual investor a shareholder in the SVP. So it's a bit similar to what we saw in my REITs video, and after deducting costs, fees and taxes, the platform would distribute the rental income proportionately amongst co-owners as monthly interest or dividend. I should also mention that these platforms typically take a fee of about 1%, and they also take a share in the profits over a certain threshold, which is generally how these guys, PMS companies and hedge funds work. In terms of returns, these platforms claim to offer a rental yield in the range of 8 to 10%. Additionally, there is the added benefit of appreciation in the property's value, which when combined with the rental yield can push up the IRR to 13, even 15% over a 5 to 6 year time span. In fact, the Strata website puts the targeted IRR at an even higher 16 to 18%, which is something I'll advise investors to verify after an allegation was made by the Morning Context that the platform had advertised an inflated IRR to its investors. However, to get a perspective, I looked at the portfolio of companies that Strata was putting up for investment, and I noticed the yield to be in that tight range of 8.5 to 10%, while the targeted IRR was around the 13% mark. Of course, as is always the case with real estate, the rental yield is unknown in advance, and unless something bad happens, this part generally comes by. The more variable part is of course the capital appreciation, which goes through its own cycles, so this targeted IRR of 13% can go a little higher or lower depending on the real estate market. However, the big roadblock when investing in fractional real estate is the ticket size, and most of these platforms require a minimum investment of 20 lakhs, which is definitely not pocket change. In terms of risk, there are three concerns that one has to consider. The first is regulation, and presently there is no specific framework that regulates fractional real estate ownership in the country. I even checked if there was an insurance policy that could protect investors from hiccups related to the title, fraud or SPV related issues, but I couldn't find any such facility. So in that context, a REIT is definitely safer as it comes within the SEBI umbrella. The second concern, which is there with all commercial real estate investments, is the challenge of occupancy rate, and your rental yields will not come through if there is no tenant occupying the premise. And finally, there is the liquidity issue, and unless the secondary market is big enough and liquid enough, the fractional real estate investor might struggle to get the right price at the time of exit. Nevertheless, fractional real estate is getting rather popular amongst HNIs, and because I am not an HNI and 20 lakhs is a lot of money going into a single investment, I'll probably take a rain check. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. The third fixed income opportunity is around asset leasing. So leasing is simply a contractual agreement between two parties for the use of an asset. On one side is the lessee, who is the user of the asset, and the other is the lessor, who is the owner of the asset. This asset can be anything, a building, a car, a tractor, or any equipment, and the lease extends for a specified period of time during which the lessee pays a regular amount to the lessor. Now, this is where platforms like Grip Invest or Giraffe come in, and they act as a conduit between retail investors like you and me and any company that wants to lease an asset. So here's how it works. Say there is a company that requires some asset, some cars for example, and they want to get it on lease rather than buying it. Sensing the opportunity, a platform like Grip Invest would collect the money from investors, purchase the required number of cars from the OEMs. They would then lease it out to the company, collect the lease payments, and distribute that money to investors on a monthly or quarterly basis. In the process, and as per Grip Invest's website, this model offers investors up to 21% in IRR on a pre-tax basis, and these leases generally run for a 2 to 3 year period. Now, 21% seemed a little on the higher side, so when I did some more secondary research, I found the yields to be more around the 12% mark, which is after deducting the 2% commission that these platforms charge. When it comes to risk, and as is the case with every lending transaction, there's always that risk of the lessee not making payments on time, and there is also the possibility that the resale value of the asset is insufficient to compensate the investor in its entirety. Other than this, there is always the fraud angle, and of course this entire setup is not layered around a regulatory framework. But having said this, the concept of asset leasing is nothing new, and what these platforms are doing is merely expanding the investor base by fractionalizing the investment amount. In my view, this is something I would consider to dip my toes into on account of the fact that a regular stream of income is coming through, and this setup is backed by some asset which can be liquidated if things go haywire. If you feel the same, then please do some more reading on it, talk to your friends on their experiences, and if you find something new, then please share it in the comments box below. A traditional fixed income portfolio comprises of a bank fixed deposit, a corporate deposit, or a Government of India bond where the returns are typically in the 6 to 8% range. Now, platforms like Wintwealth, BondScot, and Altify have been offering bonds and fixed income structured deposits that come in many shapes and sizes. One such bond type I want to discuss today is called a secured bond. For example, at the time of recording this video, Wintwealth is offering some senior secured bonds by SK Finance on its platform. Now, for many of us, this is a new word, senior secured bond. The word secured means that the bond is backed by some kind of collateral like a property or an asset, which in this case is a pool of vehicle and SME loans that this NBFC SK Finance has with it. The word senior means that these particular bondholders have a higher priority to be repaid in case the NBFC defaults. So essentially, Wintwealth is saying that it has two layers of security. The secured part, which happens via a collateral, and the senior part that comes as a higher repayment prioritization in case of default. Now, particular to this SK Finance opportunity, Wintwealth is inviting investors to put in a total of 1,60,000 rupees now, and at maturity, which happens on the 5th of April 2025, the investor will get back the principal and interest, which totals to 1,21,265 rupees, unless of course the NBFC defaults. So from a returns perspective, this comes to an XIRR of 9.25%. Of course, the big question is, will I get my money back? That is not just the interest, but also the principal. Now, to help an investor answer this question, at least in terms of probabilities, the platform offers some additional information such as the history and track record of the NBFC, some news clippings, Wintwealth's own assessment of SK Finance in terms of leverage and credit rating, some potential red flags, the collateral size, which I think is an important metric, the financials, etc. But to make it super clear and from a risk perspective, these senior secured bonds have four major risks to contend with. Now, three of these risks are pretty standard. That is, there is credit risk in these bonds, which means your principal and interest is not guaranteed if the NBFC defaults. There is liquidity risk, wherein you might not find a buyer when you wish to sell the bond. And thirdly, there is the risk of fraud with the NBFC sharing false information at the time of investment, or the platform itself doing some hanky-panky stuff. The fourth risk, and this is the one that most people will ignore, is the market risk. You see, these instruments being offered are MLDs or market-linked debentures. And if I were to explain it to say a 10-year-old, then here's how you can look at it. So if tomorrow is sunny, then I promise to give you a return of 8% on your bond. However, if tomorrow is cloudy, then I will give you only 5%. But if it rains tomorrow, then I will give only your principal back and I will not give you any interest on it. I know it's a crude example, but that's pretty much how an MLD works. And in the case of SK Finance, the MLD is linked to the yield of a particular Government of India bond, which is currently trading at an yield of around 7.4%. Now, if this yield were to go up for any reason, and if it crosses the 24% threshold at the time of maturity, then the investor will get back only the principal amount and no interest will be paid. Of course, the chances of this happening is anyone's guess, and while I don't see any indication of that happening, still the risk is always there, however little it might be. So to put it together, and from whatever I've researched so far, if you're careful with your choices, that is, you go with higher rated papers, you opt for an issuer with a high credit rating, securities which have sufficient collateral, etc., then in my opinion, having some portion of your fixed income portfolio in these kinds of bonds can still be considered. There is usually a time lag between when a vendor supplies goods or services and when he gets paid for it. This can be as high as 90 days. And to better manage cash flows during this period, many vendors approach a bank or an NBFC who then purchases these receivables at a discount and gives upfront cash to the vendor. Again, as a concept, this has been happening for many years, and now platforms like Credex, Giraffe, TradeCred and others have fractionalized it, and retail investors can start with as little as 50,000 rupees and participate in this fixed income opportunity. So here's how it works. CalPro, who has sold some goods to their client, is expecting to be paid in the next 49 days. But because they need the money now, CalPro approaches a platform like Giraffe, who would list this opportunity on their website, along with the deal size, the minimum investment required, the expected IRR, the settlement date, and some more supporting information. Now in this particular case, the investor gets to make a pre-tax IRR of 11.49%, and generally invoice discounting happens in the IRR range of 11 to 13% with tenures ranging from 30 to 90 days. From a risk perspective, it all comes down to the credibility, capacity and intention of the entity that will be making the payment, which in our example is Drytech Processes Private Limited. So if this company Drytech fails to pay the invoice or delays the payment, or if there are any delivery issues or legal troubles, then it can severely hamper the investor's return and even the receivability of principal. Of course, on its part, the platform will do its best to verify the authenticity of the raised invoice. It would also assess the payment history of the entity. They will authenticate the delivery of the product or service, maybe even seek post-dated checks, and in some cases, they might even ask for a personal guarantee from the promoter. Now, other than credit risk, which is there in any debt-based product, there are a couple of additional risks that need to be factored here. The first, and unlike asset leasing or secured bonds that we discussed earlier, invoice discounting is almost always unsecured. And secondly, there is the liquidity concern because there is no secondary market for something like invoice discounting. So there are some concerns one has to live with, but having said this, the returns from this product are definitely promising, and it also helps that the investment tenure is in the short term. Alright, so we've covered 5 different alternative investment products in this video. We looked at the returns they offer, the major risks, the investment required, if they come with some collateral or not, the lock-in period, liquidity, the tenure of these investments, and some other finer points like regulation, etc. The fact is, interest in these products is definitely increasing, and many investors, especially HNIs, family offices, and also some rich retirees are using these instruments to diversify their portfolios and to generate recurring income. In my view, some of these products can definitely be a part of one's fixed income opportunity portfolio, and I am going to try out a couple of them over the next month or two. But in terms of applying it within my portfolio, I'll prefer to split my fixed income portfolio into 2 parts for now, a lot like how I do it with equities. So I'll have a core portfolio, which is debt mutual funds, Government of India bonds, PPF, etc. And now I can create a smaller satellite fixed income portfolio for such opportunities, or as one YouTuber who was interviewing me said, an opportunity portfolio. So look at some of these products, and if you've already invested in any of these, then do let me know your experience in the comments box below. Please do like this video, do share it with your friends, and I'll see you next week. Until then.